Hello, I'm Charlotte, looking after Climate Salads community here, and thank you for joining us. This Lunch and Learn online workshop, morning tea workshop, is about startup finance and just getting your finances in order. Because Lacey, our wonderful mentor and presenter today, has pointed out to me that your brain function actually declines when you are worried about money, and you are not in the best place to run a business and get your climate tech solutions scaling. So before I do hand over, I'd like to acknowledge the traditional owners on the land of which we meet. For me, that's the Gubbi Gubbi people, and I pay my respects to their elders past and present and joining us today. And I honour their continuous connection to country, land and sea. Over to you, Lacey.
Well, thank you so much for having me, Charlotte, and thanks for that introduction. I'd like to also add my acknowledgement to the traditional custodians of the land in which I'm sitting at the moment, the Whadjuk people of the Noongar Nation, and pay my respects to all of our wonderful landowners that sovereignty was never ceded. So wherever you're coming from today, pay my respects to those elders as well. And if there's anyone on the call today who's an Indigenous Australian, a very special thank you for being here. As you heard from Charlotte, we're going to be talking about money stuff today, but the important thing for you to know, first of all, is that I'm not an accountant and I'm not a financial advisor. Now, which makes me a bit odd. I'm going to explain how I ended up teaching about money in a minute. But what I'd like to do first, I'm just going to share my screen. We're going to run through a slideshow today. So the intention is that you'll get to see these slides later. If you want to, I can share copies. But if you want to take screenshots, go right ahead, not a problem, you're welcome to. If you've got questions, pop them in the chat. I won't be monitoring the chat because of the way my screens are set up, but when we get to the end, hopefully I'll have 10 minutes to talk to you and answer any direct questions. If there's anything that's really confusing and Charlotte spots anything in the chat, she's going to jump in and cut me off and say, hey, Lacey, please explain that. Hopefully that makes sense to everybody and you're all good. And of course, you can watch the replay later. All right, so we'll get into it. You can hopefully now see the starting screen. Now,
Lacey, I'm so sorry. In my haste to mute a few people on the call, I accidentally muted you. I'm so sorry. What a great tech. Okay, please go ahead.
That's all good. It's a good test though, isn't it? Now you know which button to press. So I'll start from the talking about in and out. I'm assuming that was when I cut out. So the headline I like to say to everybody, when people are worrying about money, they're worried usually about the maths. They're worried about how complicated it looks and understanding their financial reports. There are only two things you need to remember with money. What comes in has to be bigger than what goes out over the long run. There'll be times when in is smaller than out, usually when you're starting up, but over the long run, you need in to be bigger than out. And then what you own has to be more than what you owe. So the value of the assets has to be more than the value of the debts. Okay, again, long-term thing. Now, the beautiful thing about finance is that what matters for your business is pretty similar for your personal finances. So when I'm talking about this today, you can also be thinking about your personal finances if you like. But those are the two headline things. In has to be bigger than out. That's what the crocodile's eating the bigger one for. And own bigger than what you owe. Okay, so just keep that in mind with your money. It doesn't have to be super complicated. Those two metrics, one's a short-term one, one's a long-term one, are the headline. So we're going to get into the detail of those now. The thing I'd like you to think about with your money is that it's like the lifeblood of your business. Now, when you think about the human body, we're producing blood all the time, blood circulating, but that's not the point of our lives, is it? We're not here to make blood. We don't think about it. It's not a thing that you wake up every morning and think, hey, I must make blood. But if you don't have money powering your business will eventually fall over. Doesn't matter if it's not for profit or a charity. Doesn't matter what you're doing. If you cannot make your business, social enterprise, financially sustainable, it won't survive. So as much as we'd like to think, oh, well, money is something we don't need to worry about, you really do. And you want it to be a sort of thing that you don't have to think about consciously all the time, because you've got bigger fish to fry. You've got a business to build, incredible problems to solve, and we need you to be focused on that. But if you don't get this part right, the business won't last. So that's why it's really important that you do get on top of it. Now, Charlotte did allude to this at the beginning. I've put the hyperlink down the bottom. I probably should have put QR codes. Sorry about that. but you can get those out of the slides later. So the very interesting research that came out of Princeton nearly 10 years ago, and it found that when you're under financial stress, and that's that situation which some of us have probably been in before. I certainly remember it from my university days, and depending on what your life's been like, you might have experienced it too. When you've got part of your brain worried about money, it's in the back running like a script, like if you think of it like a CPU of a computer, part of your brain has this script running and it's going, while you're supposed to be paying attention to the kids or driving or running your business, you're going, I wonder if I can afford my rent. How am I going to make payroll? How am I going to hit this next goal to satisfy my investors? And while that's happening, that is reducing your brain's capacity to solve other problems, and not just money problems, problems in all areas of life, in your relationships, in your health, in your career, in your business. That reduced cognitive capacity, which is the technical term, is actually making you dumber. So that is a huge piece of research. We used to say that poor people make bad choices. It's actually that we all make bad choices when we feel poor, because our brains are not functioning at their full capacity. And so if nothing else, I would like you to keep that in mind, because you don't want to be running your startup or your business and solving these incredible problems and having that problem with your brain. You need all cylinders firing, and you won't be as good at managing your business, managing your life, if you have financial stress. The great news is that cognitive decline is temporary, okay? So it's not one of these things that if you've been in that state for a few years, and I imagine there might be a few founders on here that might have experienced this for a period of time, it's not a permanent condition. As soon as there's enough money to reduce that stress, the cognitive capacity comes back, okay? So don't panic if you're worried that this is something that's been happening for a long time. But it is really important to acknowledge it, because if a lot of the time, people who are founders take huge personal financial risk in order to get their businesses going. So you need to acknowledge if you are feeling that stressed, or if there's a potential that you could get to that point, so you can make plans accordingly to reduce the chances of things going wrong. So that sounds quite scary, I know, but the point is to make it an imperative for you to get on top of this, so that you make sure you don't find yourself in that situation, so you can go on solving these incredible problems that you're all working on now. As I mentioned, I'm not an accountant, I'm a chemical engineer. So not the average person that you have teaching people about money. The reason why I've ended up teaching about money is my mum taught me. I started saving when I was 10, started investing when I was 19, and got to financial independence when I was 31, alongside studying as a chemical engineer and working in that career for about 10 years. What I found as I was starting to become financially independent was that I had just won the ovarian lottery, in that my mum taught me about money. I didn't realise not everybody had that chat, not every parent had that discussion over their lives about how to manage money, and that it was a real shortfall for people, particularly if you had a family that thought it was a bit taboo or wasn't comfortable talking about it. It certainly wasn't in school for most people my age. It is now, has been in the curriculum for the last 12 years. I'm not saying it's done well, but it's in there. So I've ended up teaching people about money. That's why I founded MoneySchool, and I run a business and have done for 13 years. So I understand that pressure of starting up, also starting up a not-for-profit myself this year. So I'm facing these challenges myself. Now, the reason why I feel comfortable talking about money is the maths is actually quite straightforward, and engineering typically has harder maths than you find in the finances because it's just algebra. So I don't find the finance intimidating. What I found fascinating about teaching people about money is actually the maths is such a small part of it. It's actually much more about values and ethics and beliefs and priorities. Those are the big things that dictate how people manage their money. And so I've ended up teaching people that are grown-ups about their personal finances, and then transitioning into teaching people about business finance as well in the last few years, as I've become involved as a mentor in the startup world. So that's a bit about me. The point of that, of course, is that I'm going to be giving you general information only today. So there might be personal questions that you have that are to do with your business. I can try to answer some of them if I have the answer to hand. If I don't, I'm going to direct you to other resources. So I'll help you find something that's useful for you. If you do already have an accountant, you can take this information back to them to ask them questions. And of course, I also like to mention at this point, anyone that's got personal financial concerns, if you haven't looked at them before, financial counsellors are an excellent place to start. They don't get enough airplay. Financial counsellors can't sell you anything. They literally cannot charge you any money. And so they're very good if you've got issues with things like debt or struggling to meet your bills. They can help you in those situations. They're different from advisors. I just like to throw that in there in case anyone's got that kind of situation personally or knows someone who's there. So you can seek help from those people, and we'll just be covering general educational information. Today, we're going to cover the 2 internal activities that you need to be doing. We're going to look at the 3 internal scorecards that you should be looking at, and then the 3 external reports you need to do. Okay, so I think this helps people to map out how they think about when they're going to do their money stuff and how much time they might need to allocate to do that. When everything's humming, you might spend half an hour to an hour a week on average on your money stuff, but it shouldn't be more than that. You should be able to get your systems working so that it pretty much hums along. The setup process, however, takes a bit more work, but to give you a bit of a ballpark, that's generally all right. And then of course, end of financial year, you'd probably be spending a bit more time on that to understand how you performed annually. It could be more regular if you want to, but at least annually to start with. There's 2 internal activities that you'll do, and that's pretty much the sum of it with finance. The first thing is you're going to plan. So you're going to think about what money is likely to come in, what money is likely to go out, what you need to do with that money, where it needs to go. And then you're going to track how you went against that plan. And then once you've tracked, you update the plan, and it just keeps going around in a circle like that. All your activities are either planning activities or tracking activities. Now you can use the same templates. Often these will be generated by auto reports if you're using a system like Xero or MyOb or any of those accounting packages. But you just need to think of it in those 2 chunks. Am I planning what's happening with my money, or am I tracking what's already happened to see how close I was to my plan and if my plan needs updating? The internal scorecards, so these are for your purposes. Okay, they're not for reporting purposes so much. They do feed into reporting, but these are for you to understand what's happening within your business. The first one is you need a spending and earning plan. Now, of course, the word for that is a budget. I don't like the word budget. Most people don't like the word budget. You say the word budget, and I think it's pretty much only politicians and accountants who get excited. Sorry if there's any accountants or politicians on this call. But it's not something that I think a lot of people hear and find exciting or feel joy or anything like that. And often it's quite intimidating. So I encourage you to think of it as a plan. And just like a business plan, just like a canvas or any of those kinds of things, plans change, and that is fine. Think of it as a flexible document that's going to change. The numbers are going to be updated as you understand more about your business and as things change. So get that framing in your mind that it's a plan. And then, of course, there's 2 reports that you look at, which you've probably heard the terms of. Now, remember I said that in has to be bigger than out? That's what your profit and loss is about. So we call it a P&L, profit and loss. It's your cash flow statement. How much money came in? How much money came out? Where did it come from? Where did it go to? That's what your P&L does. Now, P&L you might look at monthly, quarterly. When you're really early in your business and if you are struggling to make ends meet, you might have a look at that even weekly and forecast it weekly to see how you're going. And that is okay. It's more about your circumstances. You're going to need to do it at least every quarter because it's going to need to report into your tax stuff. But the P&L is about understanding what comes in and what goes out. The second one is the balance sheet. So the balance sheet is that second metric, what you own versus what you owe. Okay, so it's about the long-term measurement of your business. Ideally, we want to see your business building up some assets over time and being able to move forward with those assets to produce income from them. Now, of course, not-for-profits have different rules around them about this. So how much profit you can retain, those kinds of things. So you'll definitely need accounting advice as to what's a good target for your balance sheet over long term if you are in a not-for-profit structure. If you are in a for-profit structure, generally the more assets you've got, the more you have to draw on as a business to produce income. The more saleable your business is, the more stable your business is. So you want to see that what you own growing and what you owe at least staying in the same proportion or maybe less than as you go through business. Now, a balance sheet you can look at regularly if you want, but because they tend to be long-term, once a year is about the must-have for that. And generally you'd look at it at the end of financial year and have an assessment of have we got the right amount of information in here? Have we got the right numbers? Are we short somewhere? Have we picked up a liability? Annual leave is a very interesting one there if you've got employees that we need to be planning to have some extra cash flow to deal with, that kind of thing. But that's pretty much it. So hopefully that puts into frame what you need to do and why. We're going to talk as well, of course, today about your external reporting. Now, external reporting is pretty much all about the tracking. No one else needs to see your budget except for maybe if you're pitching, you know, and an investor is curious, or you're applying for a grant and the grant needs to know what you're planning to spend the money on. They're the only times you really need to share your plan. But people are very interested in how much money you make. Now, again, not-for-profits are different. So if you're not-for-profit and you've taken tax exemptions, or you've got payroll tax relief, those kinds of things, then you may not have to do all of these activities. So definitely this is one that you need advice on if you do have a not-for-profit structure. But in general, if you're running a for-profit structure, you're going to need to do a business activity statement, BAS, once every 3 months. There are specific dates those are due by. Some of you may be asked to do installment activity statements, and those are monthly. And they're generally, if the tax department thinks you're making a lot of money and we want it sooner than once a quarter. That's what they're looking for there. And then, of course, once a year, you're going to have to submit your tax return. Okay, so that's the high level reporting. We're going to get into the detail now about each of those things. I'll just check in quickly. Is there any major concerns in the chat? Anything anyone's worried about? Was it all looking okay? I can see there's a couple of comments in there. None of you look too worried. I can see a few of your faces. All right, I'll assume I'll carry on then. If you see anything worrying, just feel free to tell me to stop. Thanks, Charlotte. So let's talk about, first of all, that really essential starting point for any business. And so before you even launch a business, if there's anyone here that's in the process of launching, your spending and your earning plan, otherwise known as a budget, is the place to start. Again, I emphasize that word plan because it's going to change. It's going to change over time as you learn more. I think when we think of budgets, we tend to lock them in. I think you can be a bit more flexible with this. All you're trying to do is list what's happening. So what money's coming in, what money's going out. When is it coming in and going out? When are those bills due? When are these invoices being paid? And how much it is. And in general, you're going to have to make assumptions. You're going to have to make a guess. Sometimes if it's something new for you, you'll be going from quotes. Sometimes it will just be a thumbsuck, and that's okay. You come back and update the plan later when you have better information. But making sure that you've listed out as much as you can in as much detail as you can. Now, I tend to think of it in a visual way. Being an engineer, I like sort of driver trees. So I've mapped that out this way just to share with you guys. Now, you can see here, I've put the very non-technical terms, dollars out. The technical term that you will hear in accounting packages is expenses. Okay, so whenever someone says expenses, that's money going out. Then you have the stuff that is related to how much you sell. Okay, so it changes with the volume that you sell. So things like inventory holding costs, things like costs of shipping, transaction fees from your credit cards each time that you process a payment. Those things get lumped into a category that's kind of a variable cost that moves with the amount you sold, and it gets called cost of goods sold for products or cost of sales for services. Okay, so whenever you hear those technical terms, it's talking about the things that change by that variation whenever your volume changes. Then you've got what you would call overhead costs or fixed costs. These are the things that tend to be the same regardless of how much you sell. So often there'll be things like insurance. There might be subscriptions. Sometimes wages and salaries might have a flexible component that changes with the cost of goods sold. Sometimes they'll be fixed. Most of the time they tend to be considered an overhead. The cost of having consultants or contractors work on your stuff. So that's how your plan can generally be split out, and it helps you to.
That's it. That's all you got.
Oh, sorry. Hi, whoever that was. It's about splitting out those so you can understand which ones are going to change with volume and which ones aren't. And that helps you think about, well, if I try to change something later, if I'm trying to increase my production or if I'm trying to increase my sales, what's going to change and what won't. So that's why it helps to split those out into specific categories. Whenever you're thinking about how much you're going to spend on those things, getting estimates is a really good way to start if you don't know. Now, if you're already buying things, for example, if you've already got insurance and you know your insurance bill would be coming, or that kind of stuff, you know, that's going to be a regular fee. A lot of people might build in an incremental increase each year. I don't know about you, but my insurance bill has never gone backwards. It tends to go up by a few percent each year. So even if you look at the previous year, keep in mind that there might be an increase. Now, you might not know what that increase is, but you can generally do an estimate based on what you've seen if you've got a history. Otherwise, go online and get quotes and then unsubscribe from all the emails that they're going to send you. If you can start annually, that's enough to get going, to give you a plan. But what you might find is when different things are due, so let's say you're going to start your business and your insurance is due at the beginning and you've got to pay for the first 3 months of a lease if you need a premises, you might need to get more granular about timing. You might need to look at what's coming in and what's coming out at specific times. Because, it might be all right if you say, oh, no, we're going to break even based on my annual figures. But if all the spending happens in July and you don't get any income till June, how are you going to make it to that point? So it's going to depend on how your business runs. So that's where you might want a little bit of advice, and you might want to map it out in a monthly milestones kind of way. But annual is enough to start. You can start simple. You can start with a pen and paper, my favorite tool for planning. You can start with a whiteboard. You can do an Excel spreadsheet. I've put a link down the bottom there. The best tools that I have seen that are freely available come from Business Victoria. The VicBiz stuff is really nice, really elegant. I wish I could recommend Perth's one, WA's one from our Small Business Development Corporation, but the Vic ones are better. So if you need a template to get started, I'd recommend downloading them from there. But it doesn't need to be complicated, and you don't have to sign up to an accounting package like Xero in your very early days. I personally ran my business on spreadsheets for the first 8 years. It's certainly achievable. I've only ended up going to Xero in the last 2 years because I've really needed that extra help. We had another accounting package in between, but they simplify things. They do make it easier to track. They put things into the right buckets for you and make it quicker for your accountant to do your tax return. I certainly have been very happy having mine, but when you're very early on, you don't have to. Okay, and sometimes having something like a pen and paper or an Excel spreadsheet is good because it has to go through your brain. You have to think about it, every time you want to change something, and things don't slip past your radar. When you're thinking about how much you're going to earn, generally, it's going to be a case of how much you're selling versus what you can charge per thing that you sell. Now, whether that's a product or a service, your pricing matters, right? That's what's going to determine your money in, technically called revenue. Okay, so that's why it's got revenue over there. Oh, sorry, I flipped forward. I've got a new mouse and it's very, very responsive. What you want to do there is have a think about getting some market analysis on your volume. Now, you've probably, if you've ever had to pitch, thought about your total addressable market, those kinds of, acronyms, the TAMs and the SAMs and the, all that kind of stuff that gets thrown around. I would encourage you for an internal document to be conservative with that market analysis. Okay, so if you're like, oh, well, there's, 2 million people who do that, and if we just get 1% of them, it'll all be fabulous. Probably not good for your actual planning for your spending plan and for your earning plan. You want to be a bit more conservative in that based on what you've seen elsewhere and take up rates for other companies that have comparable things or similar business structures in different industries, rather than going with the TAMs and the SAMs for your anything that you're going to use to make your business work. That is different from when you go to pitch, of course. If you want to pitch, they'll want to know what you think you can get as a pie in the sky, kind of like what's the ambition. So just keep that in mind, that that's different from that internal, external perspective. I think for internal, you want to have a pretty high degree of confidence. So you probably go a little bit more conservative than the TAMs and SAMs of the world. Evidence-based is best. So what does that look like for a lot of businesses? If you're really early on, it might be as simple as taking your prototype, attempting to sell it to 10, 20, 50 businesses, 50 clients, and seeing what your percentage take-up rate is and working off that as a basis. It might be calling people or getting on the Slack channel in Climate Salad and asking people what their rates are, and getting some of that benchmarking with similar businesses. If you don't have those, then make a best guess. It's fine. Remember that it should be conservative, so go a little bit lower on what you think you might sell, go a little bit higher on what you think you might spend when you're doing your first plan. But remember, it's a plan and you can update it later when you have more evidence. So as you progress, come back and update that number when you've got more confidence. What you really want to understand is, what is your break-even point? So based on those expenses that you had, how much do you have to sell at the price that you've chosen to break even so that you can operate without having to go into debt or take money out of your personal savings? So that's probably, I think, the most important thing when you're designing your business to understand. So when you put them together, it looks like this. You have that in section, the revenue in, you have the out section with the expenses, and you go in minus out, If it's a positive number, you're going to have a profit. If it's a negative number, you're going to have a loss. So you can see the maths isn't complicated, but making sure that you understand what it is that's creating that profit or loss will help you to focus on what you need to track. Okay, so you're not looking at everything. You can say, well, I can see that I've got a profit. If I play with price a little bit, it'll make a difference. We'll talk a little bit about that in a minute. But I think this sort of visual way of presenting it can be more useful than numbers on a spreadsheet. So if you find looking at columns of numbers a bit annoying, draw yourself out this driver tree and just throw your numbers into it. Okay, or if you're fancy and you want to do it in Excel, go for that as well. I can share an Excel template that I use if anyone wants it. It's manual, but feel free if you want. So your profit and loss, that reporting, remember we did the plan, now you're going to report. It's basically the same format as your plan, but you just put in your actual dollars where your plan was. So often we'll keep the plan numbers and then we'll put the actuals and you can see how close you were. Did I have that wildly right or wrong? Was that about on par? So that you can actually see how that looks. Now, there is a formal layout for how a P&L is structured to look at those variable costs and fixed costs, which I'll show in a minute. Now, I've put there, do this regularly. So like I said, for some businesses who are new or really bootstrapping it, and there are businesses that can be going for 10 years that are really bootstrapping it, it is important to do this as regularly as you need to sleep well, so that you can feel confident that you know where your money is going. Now, for some people, that'll be weekly. For some, it'll be monthly. For some, it'll be quarterly. You will need to do it quarterly for your reporting anyway, so that's probably the maximum. But if you need to do it more frequently, please do. The point of it is not to be intimidating or to take a lot of time. It's to give you confidence so that you understand where things are going and so you can adjust accordingly. There's nothing worse than ignoring all that and finding out you've been trading insolvent and having a problem, right? So doing it early is preventative, okay? It's not supposed to scare you. It's not supposed to be about, really freaking anybody out. It's about you feeling comfortable and confident that you know where your money is going and that you're going to be okay to meet your next milestone. So the layout that I mentioned is a pretty formal one. And the reason that they do that formally is because it makes it easier to benchmark businesses. Right? So if you've got businesses that have got high overheads versus one that have got low overheads, you don't want to be comparing profit margins on those as an absolute, because the way the businesses run is very different. So that's why they split it into those two chunks. So they take your income in, so how much did you earn? And that might have multiple line items, but it's the total you care about. Then they take out those variable costs, the cost of goods sold or the cost of sales. So that's the things that like the transaction fees and inventory and shipping, that kind of thing. Then you've got your gross profit. Okay, then they take out the expenses, the fixed overheads, and then you get your net profit. Now, of course, net profit is what we care about. But if you're trying to benchmark with other businesses, you will want to look at gross profit versus net profit so that you're not giving yourself unrealistic expectations. That's what that's about. And of course, it's a formal process and that's what accountants do. So that's the format you'll get. Now, what do you have at the end of that? If in is bigger than out, you've got a going concern, you're making a profit. If in is less than out, you've got a loss. Now, after a certain period of time, that can be considered insolvent. Now, for people who are operating under company law, there are implications for that. It's not something you can do indefinitely. So you need to be aware of whether you are in that situation or not. Very clear processes to follow about what to do and what the metrics are on those. Again, that's an accountant's area of advice. You'll need to talk to them if you're concerned that you might be heading into that territory and following the right processes, particularly if you've got people who you're going to owe money to, or you've got investors or any of that reporting stuff, okay? Now, remember, cash flow is king. This is my favorite. We all hear the fantastic raises. So-and-so raised $100 million, seed round, Series A, Series B, it's all very exciting. Look, cash flow is king. I love this tweet. Excited to announce we've closed an $8,842 round of funding from our customers today. Basically, we sold some stuff. If you can sell, it's the best money you can get, okay? Cash flow is king, but profit is the point. And you might have heard this phrase before. I don't know who to attribute it to. If anyone knows, let me know. It's one of those ones I've picked up on YouTube somewhere probably. In business, revenue is vanity, profit is sanity. And I mean that in the very literal sense of that IQ impacting financial stress. So whenever you hear about so-and-so doing massive revenue numbers, it's irrelevant. Like if they sell $4 million worth of stuff and they spend 3.95 million, unless they're not for profit and dictated that they must do that, they're not going to last forever. Okay. So that profit is what you need to sustain that business long-term, to be able to grow, to be able to invest, to be able to make your business more competitive. Okay. So remember that one. Revenue is sanity, profit is sanity. So when you're thinking about that, you might have done your first plan, or maybe you're looking at what's happening with your business and you're not too happy. I find it useful to think about which lever can I pull to improve my finances. Now, these are pretty obvious to people, but I think it's worth going through those step by step with your business if you're worried or you're not happy that you've hit your targets that you should. So can you charge a higher price for your thing, your service, your product? Often we will set prices quite low early on and not often raise them quickly enough. Now, the research that came out of Curtin a couple of years ago, I'll try and find it for you, but basically showed that of all the things you can do, raising your prices was the thing that was most likely to make you profitable, had the biggest impact, which makes sense, right? And we've all probably had that happen to us where we've got an essential service and they put it up by a little bit and you've gone, oh, well, it's worth it. I can't get around it. Remember to think about your prices and keep an eye on what's happening in the market to see whether you can increase them. I'm not saying gouge. I'm saying make sure you're staying competitive and benchmarking. Then there's volume, of course, which is what most of us are interested in, particularly early on. How can you sell more? What would it take to sell more? What would those costs be? So are you going to focus on increasing price, or are you going to focus on increasing your customer base? And then, of course, with your selling costs, it helps to categorize them into those fixed and variable costs. So remember, the variable costs are the what am I paying on my transaction fees at the moment? What am I paying on my shipping fees and my inventory, my storage, that kind of stuff? What am I paying on the casual wages that have to man the store that operates for this period of time? That kind of thing that is dictated by the volume yourself. And then, of course, the one that everybody talks about, I think the most, which is your overhead, your fixed costs, because the lower you can get those, the more nimble you can be, basically. Now, there is a limit to that, and it depends on whether you have a physical premises, depends on whether you have full-time or part-time staff. Those can be harder areas to reduce. I personally prefer to focus on price and volume because I like trying to increase income rather than cut costs. Personal preference. I'm not going to spend too much time on this because I think you spent a bit of time on it last week. Is that right, with KPMG, where you were talking about startup funding? Is that right? Did I misunderstand that, or sort of? Okay. So look, these slides are in here. I won't go through all the pluses and minuses on the next slide, but it's basically about how do you get that startup capital, which is often a question. I'm not sure how many people we've got very early on in their stage of their business in this call, but that's generally the hierarchical order you would start in. Bootstrap it, use your saved cash, ask your friends, family, and fools, the 3 Fs round, if they're willing to put any money in towards your startup. You might negotiate with supply chain partners, so people who are going to be providing something that's going to help you make your product or service might be willing to take a cut in order to sustain you. There's some great examples of that with mining over here in WA. You might be looking at grants, and then you might start looking at how do I get money out of people to take either a share of the business or to give me a loan, right? So that's the sort of the boundary at which you change over. Angel investors, of course, are people who tend to make smaller amounts of investment and have a higher tolerance for risk. They're often doing things because they feel passionate about them. And that's a bit different from going from venture capital, which is where you might have a pre-seed and then a seed round. And then, of course, you can go to banks. Pretty tough to get a loan from a bank unless you've got a fair amount of assets behind it or a personal guarantee. Now, the reason why I'm flagging that is there are pluses and minuses to each of those. Like I said, I won't run through these. I'll just leave them in the slides. You can read them later if you're looking for funding. Given this is an accounting, books one, I didn't want to go into too much detail, but it's there. There's good parts and bad parts for each of those. Okay, so it's important that you're thinking about with your business which one's going to work best for you over the long term. Okay, none of them are fabulously perfect. I mean, cash flow from revenue is the best one, but it's really slow. That's the thing. It tends to be very slow to get started. So important to work out what's going to be best for you. Like I said, I won't labor that one. All right, you've got your feedback loop starting now. Remember, we had our circle. You did your P&L. So you had your plan, you did your P&L, we've had some results. It's now important that you take that result, whatever happened with your P&L, what actually was sold, what actually was spent, and you go back to your plan and you update those figures so that your next plan, whether it's the next quarter or the next financial year, is more accurate, because it's going to help you feel like you've got a better hold on your business, like you understand what's going on. That would typically be called forecasting. So you usually have a budget, a forecast, and an actuals when you look at that spreadsheet. That's what we mean by forecasting, is updating that same plan with, hey, this has changed. We're going to have to spend more here. Or, hey, we got a better price on this thing, so we're spending less. That's what the point of that is. The more you do that, the more accurate your models become, the more confidence you can have, the better you sleep. That's how I think about it. Now, the balance sheet, as I said, is the next piece. That's the long-term scorecard. Like I said, once a year is generally when people will look at that. You might want to look at it more frequently until you're comfortable with it. And it's certainly available quarterly for most businesses when you do your P&L, because those things flow through to your balance sheet. What you're trying to do is assess your equity. So that's the value of your assets minus your liabilities. That's basically the maths in there. And it's useful to get ratios for comparison with other businesses to see how healthy your business is. And if you ever go for venture capital funding or anything like that, then they will be looking for those kinds of ratios to explain how your business looks. So there's a few definitions you have to be across. Now, if you have an accounting package or you have an accountant who is recommending these, helping you with these things, then you don't have to understand them exactly. Most of your stuff will be mapped for you. It will say that's current, that's non-current, that's an asset, that's a liability. If you're doing it yourself, it is important that you get comfortable with these terms and understand the difference between what they mean. An asset is something that you own. One thing that I think that's pretty interesting is what's the value of your intellectual property? Have fun valuing that. But everything else, it's, do we own a car? Do we own some equipment that we use? Do we own, a patent? Those kinds of things. Those can be assets. A liability is the money you owe, things you have to pay, debts, that kind of stuff. And then there's two categories within those, current and non-current. Accountants are really creative with their naming. Sorry if there's any accountants on here. So current just means it's going to happen in this financial year. Non-current means it's not in this financial year. It's a longer term issue. So there's a few examples in here. So a current asset, things like cash, things like the amount of money your customers owe you. You've sent that invoice and they haven't paid you yet, but you're waiting for that money and it's considered to be expected revenue. Any stock you're holding, those things are current. Non-current assets might be things like plant and equipment. So things that you buy once and hold for years. Property, vehicles, those kinds of things, non-current assets. Okay. Now for the sum of your balance sheet, doesn't matter whether it's current or not current, it's still an asset. But it's about the timing, about how liquid those are and how often you have to manage them. Current liabilities, so things that you owe, are things that you have to pay. So contractors that you have to pay or subscriptions you have to pay. If you have a credit card, right? Some of you might have a business credit card. What's the amount owed on that? And your tax payable. So as we know, we pay our tax and our superannuation in installments. And often that will be quarterly at the moment for BAS, for example, though it's looking like we might be paying super more frequently. Those kinds of things are things that have to be paid in that current year. Non-current liabilities. Now, I think the most interesting one of this is, of course, the annual and long service leave accrued. So anyone with employees, if people are accruing annual leave or long service leave over time and their salaries are increasing, the monetary value of that leave goes up over time. And you often hear in big companies why they force people to take annual leave, why they say you can't have a balance of more than 6 weeks. This is why, because those leave days get more and more expensive for the company. So that's why they want you to keep it under a certain limit. Now, if you have long-term employees, that's a great problem to have, but it's why you might need to keep track of what the value of that leave is over time and make sure that you're not setting yourself up to have to pay out massive amounts of money in a big hit. Okay. But long-term loans is an example of that. If you've had an impact investment debt arrangement, if you've taken a leased vehicle that has a balloon payment, where you pay off a fraction of the value and you pay off the bulk of it at the end, those kinds of things don't happen in that financial year, but have to be carried forward because they're going to have to come out eventually. Basically, this is how you balance sheet: total of your assets minus the total of your liabilities. Now, when the value of your assets is bigger than the value of your liabilities, that's great. You have equity. You have some flex room in your business. When it's the other way around, when liabilities are bigger than your assets, then usually you're going to have to look at debt. You're running yourself into a problem. So it's not sustainable in the long term. Now, of course, not-for-profit rules affect this. Again, please get advice on that because there are rules about how much you can carry forward if you're a not-for-profit, because you're not supposed to accrue stuff necessarily. It just depends on what you're doing and your activity. So definitely get advice on that, please. But in theory, and particularly in your personal life as well, you want the value of your assets to be going up and the value of your liabilities to not be increasing proportional to that. You want it to get smaller if you can. Okay, so nice simple maths. And it's just about that equity number at the end. Again, you probably look at that once a year. Now, I mentioned indicators that you might use to compare things. So I'm just going to run through two. There's a lot of them out there. This one's particularly good for startups, and you might hear these used if you're ever going for investment. So the first one is called remaining months of liquidity, RML, which basically means how many months till you go broke. That's it. Okay. So the way that you look at that is the total of the cash you've got and accounts receivable. So how much money you're holding right now, and then how much money your customers are going to pay you, that number. Okay. And then you work out how much you're spending per month, comes from your P&L. That's the burn rate. We all love that. We could play buzzword bingo with this one, couldn't we? Burn rate. So you take that cash divided by your burn rate. That will tell you how many months you've got till you're broke. Your runway, if you like. Now, you want to make that number big, right? The bigger that number is, the better you're going to sleep, and the longer you've got to make mistakes and adjustments. When that number gets to 6 months or less, it's very stressful, especially if people have employees. So I would encourage you to keep an eye on that metric, and just hopefully it gets 12 months or bigger, because that gives you breathing room. Okay. Good exercise to do with your business now, though, if you haven't done it before. Go and have a look at that remaining months of liquidity. The second one is if you are taking on debts or you're accruing leave. And this is one that's commonly used in banks, but also investors will look at. What's the value of your current assets, so the ones that have to happen in this financial year, and your current liabilities, the ones that have to happen in this financial year. And you divide assets divided by your liabilities, and that says, can I pay my debts? Now, if it's 1 or greater, that means you've got more assets than you've got debts in that year. So you're going to be okay. You can cover those debts generally. You might have to sell some things depending on where those assets are. If it's less than 1, that means your liabilities are bigger than your assets, which means you owe more than you think you're going to earn, which is a sign that you haven't got enough income. So you've either got to cut costs or try and earn more. So that current ratio is one that is commonly used for benchmarking. Now, there's heaps of other ones, but I think those two are quite a good starting point for most businesses if you haven't done those already. And it might be interesting. I don't know if you want to try and do this, Charlotte. If people want to try and compare their numbers later, we could do a thread in the Slack channel where you can kind of benchmark each other and see if there's any, hey, mine's about this. How's that going? So if you want to do that, maybe think about it, but definitely worth understanding. Now, in terms of external reporting, you have obligations. Please meet them. Now, the rules just get worse and worse for this. They've changed the directors' laws recently, where they don't have to issue a certain number of notices before they start forcing you into their fines and then eventual litigation channels. And we've all got director IDs now, all that kind of stuff. Tax is inevitable. Do what you have to do to deal with it, and just focus on making more money. Don't spend lots and lots of time focused on your tax, okay? Because it is inevitable. The financial year, most people would know, runs from 1 July to 30 June. So whenever we hear FY, it's always for the second part of that, the bit that ends in 30 June. That's why FY23. We're basically feeding the ATO. That's what they're after. And they have got a big organisation, very interested in your money. So they're not going to let you get away with paying less than you owe. When you're starting a business early, your focus will tend to be on GST and then the pay-as-you-go income tax stuff, okay? So with GST, it's important that you are tracking your receipts, because GST is not universal. It's applied differently and to different things. Some things are exempt and some things aren't. Even if you pull out your vehicle registration and have a look at that, there's a component that's got GST and a component that doesn't. You can't avoid tracking your receipts to track things like GST. And you want to understand how much GST you've charged people and then how much you've spent, because the difference between the two is what determines how much you have to give the ATO. Okay, so if you're not doing that yet, that's one thing that's worth getting right. Your business activity statement is due quarterly on the 28th of the quarter. Now, April, July, and October are all for those quarters that ended, 4 weeks prior. The reason that we had the 28th of February is because Christmas is a tough period for most people to get their accounts done. So they give you an extra month for that BAS. So that's why it's a bit longer. If you appoint a tax agent, they're allowed longer again. Okay, so just keep in mind that having a tax agent gives you some a bit more leeway, and they can negotiate those if you need to take longer. You can do it yourself if you want to. These days, the templates are pretty straightforward, and particularly in the early days, you may want to, but you can also get a registered BAS agent. That's not necessarily having to get an accountant. Some people just register as BAS agents as just this one particular thing that they do. It's like a sort of similar to being a bookkeeper in terms of the level of training. I mean, a bit more advanced, but it's not as expensive as an accountant. So if you don't have an accountant appointed, you could look for a registered BAS agent, check their registration, make sure they are registered. And as I said, watch out for that GST. It's not universal. There's no way to get around keeping receipts, people. You have to do it, okay? The installment activity is not something that you would opt in for generally. It would be something you get told you're going to do by the ATO. And as I said, it's usually about, we think you're making a lot of profit and we would like your money earlier because the ATO would like to earn interest on your money, and rather than leaving you to earn interest on your money. That's the basic principle behind it. If you do that, it's similar to doing a mini BAS, and you do it once a month. And again, you can do it yourself or get a registered agent to do it. If you've got the option to not do one, I would choose that option, because who wants more reporting unless you have to? And then, of course, you have your tax return. It's due every year. Now, those dates are about whether you have a tax agent or not. Okay, so it's, if you're doing it yourself, 31st of October. Your goal is basically to legally minimize your tax. Okay, and that is pretty much all done in the structure of the business when you set up. That is where the majority of your tax benefit will come from, understanding what corporate structure you're going to use, whether you're using a company, a trust, not-for-profit, a public company limited by guarantee, all those kinds of things, and how that structuring is going to determine really how much tax you're going to pay. Okay, much more so than how you juggle the books later on. That's your biggest leverage point. So if you haven't set up yet, that's worth doing. If you're not comfortable or confident that you did a good job of your setup at the beginning to get the most out of your tax, you can do a consult with someone now and see if there's something you could improve. Just be aware that the moment that you're moving things from one business to another, there might be tax paid on things like capital gains, that kind of stuff. So sometimes it's not worth it. Sometimes you just stick with what you've got, but you can ask the question. And again, you can either do it yourself or get a registered tax agent. Who can help you with these things? You can get a bookkeeper. If you think you're okay with your reporting, you can get a bookkeeper, which is less expensive than an accountant, and they can just help you make sure that everything goes in the right spot and that you're tracking what you're doing and have all your books prepared. You can get an accountant. Now, that's a formal qualification, so please do check. But remember, there are different types of accountants. There are tax accountants, management accountants, and financial accountants. Some of you might just want a tax accountant. You might not want the advice. Sometimes you will want the advice. Just be aware of the skills of the type of agent that you're looking for and make sure that they do have a registration with CA or CPA. I think there's a third body. I think it's the professional accountants body. So just make sure that they are registered and check that they are, because there have been people who've done dodgy things before. Now, you and your staff, just the big thing you can do is build good habits. And by that, I mean making sure you keep your receipts, whether it's taking a photo and sending it off to an app or sending it to your Xero or whatever you're using, or just keeping a pile of them on your desk or an email folder on your computer, whatever it is, getting good habits about keeping those and reconciling them regularly. That is probably the easiest way to make your life simple with your books, as boring as it is. But getting people into good habits early will mean that you don't have to then spend hours working out what happened later. Of course, you can get advisors as well to help you with benchmarking, and that's where you'll want those reports to understand what your totals and your ratios look like and how they compare. And remember, those can be formal or informal advisors. Sometimes you'll pay them, sometimes, it's someone on your advisory board. Feel free to ask. And of course, you can always go to the bank and ask for money. Now, what you might expect at a pitch, and this is my last slide, so I'll ask if anyone's got questions shortly. So if you have got questions, pop them in the chat. But I just want to make this point to people that are thinking about pitching for funding, because generally people are. What might you get asked by someone who's thinking about giving you money? The first thing they'll ask is, what assumptions are in your models? How did you decide that you're going to sell 1,000 widgets? Why did you pick that price? That kind of stuff. Expect to be tested on those. It is reasonable to say this is a guess because we don't have any other information. But if it's something you could have got information on, you might get queried on that. So be aware that it is worth understanding what was something you guessed and what was something that's based on some kind of fact or evidence. With your forecasts, how confident are you in those? Are you thinking, it's a 50-50? Oh no, we're pretty much 90% confident this will work because we've seen it happen over here with this similar product, or we've got this history. What proof do you have to back that up? Where did you get your numbers from? Oh, I had a chat with so-and-so down the pub and they said it's probably not going to be enough. So keep that in mind. I think one of the biggest ones that comes across, certainly when I'm hearing from people pitching, which I do a lot with Curtin Ignition over here, is your attitude to waste reduction. Now, I think in this space, most of us are waste conscious. We don't have a lot of the tech bro attitude where they come in and buy a whole building and fancy cars. Okay, I haven't seen a lot of that. But if you can demonstrate that you are not wasteful with money, people are more likely to be willing to give you money because they think they'll have a bigger output. Does that make sense? Hopefully it does. This idea of if you are taking the time to be careful about what you spend, and you're not wasting money by just letting subscriptions pile up or taking on debts that you don't need, then you look like someone who makes sensible financial choices. You're more likely to get investment. And then, of course, there's risk with all of this stuff, but is the risk managed? How are your accounting practices and your ways of tracking your money, making sure that you're flagging things that are an issue early and actioning them? What processes have you got? And is that balanced with the reward potential? Okay, so we're at 8 minutes to the hour. So we've got a little bit of time for questions. I'll just pull up the chat now and see if there are any in there. Okie dokie. So I like your comment, Charlotte, about it doesn't motivate me, but it really matters. Sad but true. I think it's like, diet and exercise, you just have to do it, right? Like you just got to, we've got to eat reasonably well and we've got to move. This is the same. You've just got to do it. What percentage do you recommend as what do you recommend as the percentage of TAM? Now, I do not have a benchmark number for that. What's the, if you're looking at your total addressable market, what would you pick? It's very much on the individual product or service that you're selling, because it will vary wildly. Like it can be as little as fractions of a percent to 50% or more, depending on what you're providing. So it's not one I think that you can give a benchmark on. It will be very much by industry, but I would suggest talking to your advisory board or someone who's got expertise in your particular industry to help test those to get some some ranges. If you're not entirely sure, the other thing you can do is run multiple versions of your plan with different percentages. So what if it was 0.1%? What if it was 2%? That kind of thing. So you can have a hey, we think the probability is higher on this one. And that's a risk reward balance that people do in maths. It just means you copy the same spreadsheets across or the same models across and just do those different scenarios to see which one's going to let you break even. And if you don't know exactly what percentage you should use, just knowing your break even point is enough to say, we will break even if we sell to X percent of the TAM. That can be enough to get you past an investor. So that's another approach to try. So sorry, I haven't got a specific number for you there. And yes, I will happily send you those spreadsheet templates, definitely. And you've got an app in there to track for tax. No other questions, I think. Is that everybody then? Any other questions anyone wants to raise?
It's a great time to pick Lacey's brain, although I know there isn't a lot of time left, but we can also catch you in Slack and email or LinkedIn. Email's
best. I'm a shopper with any messages on LinkedIn or anything else. Email's best for me, please.
Yes, so am I. Well, thank you so much for running through that. It was so good to go through, just simplifying it to non-accounting brain terms, which is very, very, very useful. So thank you. And it was quite different to the panel discussion we had about finance last week. So are there any final questions before we close out? Oh, no, just comments about great presentation. I mean, Lacey is a
lovely.
Thank you so much for your time today. You can have a few more minutes back in your day. And Lacey, as always, it's so great to dive into your brain and just make it really simple to understand finance 101 for startups.
I'm glad. It's one of those things where there's so much jargon and it looks overwhelming. I hope it does help. And you'll probably, if you're like me, you'll think of a question tonight, when you're having a shower, getting ready for bed, or like off for a walk or whatever. Feel free to email them through. Honestly, please do. I'm always happy to answer them. And if I don't know the answer, I will know someone who does. I will send you off to the best resource I can find.
Thank you so much.